So Tom Lee and Dan Ives are making some crazy predictions for the stock market for 2025 and for 2030. 2030, Tom Lee just recently said he thinks the stock market is going to triple from current levels of what we're at right now. Totally crazy. So we're going to break down these two interviews from Tom Lee and Dan Ives, breaking down why they're going to get to these price targets for 2025 and 2030, and then the potential risks that are coming up in the economy right now that could actually crash the stock market.
You have not been drinking?
No.
Okay.
Not recently.
Not recently. 15,000. I'm just going to sit here and listen.
Okay. Well, there's a couple of reasons behind this. One is this would be the third time that stocks entered a cycle where annual returns compound at high teens. You know, you had the roaring 20s, and then you had the 50s through the late 60s. Mm-hmm. And this is a third cycle. They all coincided with a surge in the number of people aged 30 to 50. So in other words, the number of prime age adults. And this time it's powered by millennials and Gen Z.
Big numbers get bigger faster. That compounding.
That's right.
And you think there's that, but there's also this massive wave of people about to enter their peak earnings years.
Yeah, so it's a...
Demographics.
Exactly. It's a demand story, meaning when you get to your prime years, 30 to 50, Urban Institute shows you start to borrow more money. You're making big life decisions. This is what powers the economy. On top of that, we have a really a big opportunity for U.S. technology companies because of AI, which is supplying the global digital labor because there's a global labor shortage. So these two forces are combining to, I think, power almost a decade of extraordinarily good stock returns.
Do you have a view? Is this because we're the United States? I mean, and do you expect that a lot of money from around the world, because China's got massive demographic issues, Germany shot itself in the foot with all of its energy problems. Will we be helped by a lot of money coming into America, or does that have nothing to do with it?
It's actually both. I think that there's going to be a lot of dollars spent on U.S. technology product because the world is short 80 million workers by the end of this decade. That's roughly $3 trillion of labor shortage, of labor salary that's turning into silicon. So that means U.S. suppliers of silicon and AI are going to have a $3 trillion revenue run rate. On top of that, if U.S. companies are growing earnings at this speed, the PE multiple of the U.S. should go up, and that's exactly your point. There's going to be capital flows into the U.S. And where else in the world do you find the best and most important technology companies?
We have American ingenuity. We have an amazing workforce. 25% of company founders, by the way, are not born here because we allow a lot of immigration. It's a bold call. What's the risk? When you look at it, you've always got to analyze, say, well, where could I be wrong, right?
Yep. Well, I think there's a risk that we could have
global recession.
A global recession. AI, of course, could become an adversarial development and, upend state nations and cause chaos. But we could also have a risk that it's a bubble and it peaks a lot sooner.
Now, the S&P tech sector closing at a record today, and the Dow closed higher for the fourth straight day, its longest winning streak in nearly a month. Joining us now is Fundstrat Global Advisors Head of Research, Tom Lee. He is also a CNBC contributor. Happy holidays to you, Tom. Thank you for being here. I want to ask you about the animal spirits, because I was reading in the producer's notes that you believe they come back next year. What species of animals come back, and were they hibernating this year? Because we saw some species out in full force in 2024. So I'm curious which ones you think will be in full force in 2025.
What I'm thinking about with animal spirits, and it's a Milton Friedman reference, is the ISM's been below 50 for almost 3 years, meaning companies have been cautious. Their visibility hasn't been great. But finally, the Fed is cutting. And we have an incoming administration that's seen as very business friendly. And so I think companies for the first time in a long time are going to be expansionary, feel confident doing mergers. I think this is a very good environment for small caps, mid caps, the financials, and cyclicals broadly like industrial. So I think it's going to feel a lot like the market broadens in 2025. even as tech sort of keeps up with the market.
Now, I know you are a quintessential optimist, Tom, but I'm curious, where do you see the biggest risks to that forecast for next year?
The big foil in 2025 is going to be whether or not there's a policy error, and there can be two sources. One would be if the incoming administration does implement tariffs that are damaging to the economy because we know that they'd be immediate effects, or if there are mass deportations that have some unknown impact on labor markets. The other source would be if the Fed becomes too inflation focused and allows the labor market to weaken. And so we actually slip from the Fed sort of trying to support the economy to the Fed trying to save it. I think that would be a very adverse development.
Dan, it is great to have best dressed guy on Wall Street, man. Best dressed guy.
Great to be here as always.
All right, so another bullish note. In all fairness for the audience, you're pretty much bullish on all tech. You're always bullish. AI party, it's 10 o'clock, goes to 4 o'clock, there's an after party. I understand the whole narrative. But on a very serious note, we're looking at Apple right now. What pushes this company even higher?
I mean, our supply chain checks coming out of Asia are bullish. I mean, I think right now they're trending 5 to 10 million iPhone units ahead of the street. And what that means is you have a strong holiday season. The AI revolution on the consumer side comes through Cupertino. But ultimately, we could talk about the AI revolution from an enterprise, goes through Godfather of AI, Jensen, NVIDIA, and as well as Palantir and others. The consumer AI revolution from an Apple Intelligence will come through the iPhone. And that's why, look, the bears, they can't see AI in the spreadsheets. But look, I think right now it's really going to be, if you look at Roblox, you look at some of these other sort of consumer-driven names, Frank, our view is we're just starting now. It's year 3 of what's going to be a 5 to 6 year bull market. But Apple, Cook, they're going to be a key player in this AI party.
So let's break down what Tom Lee and Dan just said. So Dan is super bullish on tech. Dan's super bullish on AI. Tom is pretty much bullish on tech and AI at the same time together. Tom Lee did predict that the S&P 500 is going to triple, go to $15,000 by 2030. Is it possible? Of course. So we need to break down the current valuations of the stock market right now, and I'm going to give you my personal opinion on this because I kind of believe what Tom and Dan are saying, but I do feel like they're pretty much pricing in perfection into the market. I don't always like to price perfection in because if perfection doesn't happen, the stock market will correct lower. So heading into my alpha report, I did break it down. So one of the most important things that I look at for valuations of the stock market, and it's just one thing, this is not like the end all be all, it's just a way to get a general consensus of the valuation of the stock market. So the forward PE ratio of the S&P 500 is roughly 22 right now, and the forward for the NASDAQ is roughly 28. So what that basically means is at the current profit levels, at the current earnings levels of the companies within those indexes, it would take you 28 years to get your money back in profit on the NASDAQ and 22 years to get your money back on the S&P 500. So basically, if you were to buy the entire index, I know it's not possible, but if you would, it would take you 28 years, like I just said, to get your initial investment back and 22 years here for the S&P 500. So looking at this chart right here, the green line here is the S&P 500 PE ratio. The gray areas right here are where there was recession. So this was a pandemic. This was 2008. And you could see that historically speaking, this green line right here, we're kind of historically high for the forward PE ratio of the S&P 500. So this is forward. Now, if we go right here, this is trailing. So trailing is definitely super high. I mean, we really haven't seen levels of 30.98, which is what this says right here, pretty much in all of history. I mean, only a couple of times right here. And this goes all the way back to 1880. So this is a lot of data right here, and it's basically saying in the last 130 years, the stock market has not been as lofty as it was right now. But remember, this is a trailing basis right here, and this is a forward-looking basis right here. So the reason why forward is so much lower than trailing is because forward is basically taking the earnings that are expected to happen in the next 12 months and then bringing them back to current right now. I tell you guys all the time, the stock market is usually forward-looking by roughly 1 year, so it's pulling those earnings back to right now and then putting it into the PE ratio right there. So 22 right there versus 30 right here. So what this is basically saying is there's a lot of earnings growth that is expected to come next year, and that's pretty much why there's perfection priced into the market. These companies are truly growing. NVIDIA is growing like crazy. Tesla is starting to grow. Tesla's on a cusp, in my opinion, of a really big growth cycle, but it hasn't started yet and it's not guaranteed to happen. There is still risks in that play, but a lot of the companies and the leading companies in the NASDAQ index, they are making a crap ton of money. So it's kind of like perfection is priced in, but perfection could happen. We don't really know, but I would say right now I feel like the stock market is a little bit expensive. And one other thing that we have to look at before I give you a really interesting example is what interest rates are at right now in comparison to history. So this right here is a chart of what the interest rates are, and this chart goes all the way back to 1955 right here. So pretty much from 1955 to 1980, rates trended all the way up. And it's pretty crazy. Like in 1980, interest rates were somewhere around like 18, almost 20%. Literally, if you want to go get a mortgage on a house in the 80s, I know some of the older people that are watching this video right now, you probably remember going and getting a mortgage and your rate was like 20%. But then at the same time, you could go to a bank and get like a 20% CD. Maybe not 20%, probably like 15 to 20%, somewhere in that range. But you could get a CD or a bond for that super high interest rate. So when rates were that high, there was really no need to go into the stock market because you could get a really good yield rate here, which is pretty much a guaranteed return from the US government. But now since the 80s, we've been on this sharp decline of interest rates all the way to current. I know we're locally high right here on the rates, but we are in a cutting cycle right now. Inflation is trending towards the Fed's 2% target. So now interest rates are trending down, so there becomes less gravity on the stock market. So as interest rates continue to trend lower, which is what is expected, this high PE ratio here kind of becomes justified because there's really no other game in town. Warren Buffett, who has billions and billions of dollars, hundreds of billions of dollars, he has said many times that rates are pretty much everything. Rates are gravity on the stock market. So if rates go down, stock market valuations can go up. But here's the deal. Here's a couple risks to the situation right here. What if inflation comes back? If inflation comes back, the Fed's going to signal they're going to be higher for longer on interest rates. That's what they kind of did last week, where they basically said next year we're only expecting to do 2 cuts instead of 4 cuts. And that's why the market went down pretty sharply soon after Jerome Powell said that. So the market had to do a correction right there because we're expecting roughly 50 basis points of cuts versus 100 basis points of cuts for 2025. So in just a second, I'm going to give you my price target for the S&P 500 and the NASDAQ for 2030. But I want to show you one more thing, and then we're going to get into that. So is the market overvalued right now? Do I feel like we're going to get a stock market crash? And how do I feel like AI works into this whole picture right here? So if you look at the S&P 500 earnings growth for the last 5 years, we do this right here. These are the percentages of growth right here. If we take that together and we add it up, that's going to equal in a simple way, simple interest way, 91% earnings growth in the last 5 years of the S&P 500. But guess what? The S&P 500 went up 91% too. So when I tell you guys on Discord or on X all day long, the earnings are the number one thing that matters for a stock in the long run, this is proof right here. It's not a coincidence that the S&P 500 went up roughly 91%, and so did the earnings. It's not the Fibonacci, it's not the moving average, it's not the VWAP, all that stuff. There is value in that stuff, but the main whale in the room is what the earnings of these companies do. So these are some of my price targets right here for 2025, so definitely go through here and check all this stuff out. And for 2030, some of the biggest winners that I see for 2030, obviously I like Triple Q, I like VOO. SOX is a good one. I love SOX. Tesla, if Tesla actually comes out with Optimus and full self-driving on a mass scale, I think that's going to be massive for the stock by 2030. I know the stock did run up quite a bit in the recent times, and the stock could take a correction down because I feel like it's a little bit lofty on a local basis. But if we look forward 5 years to 2030, I do feel like if they come out with what they're trying to do, it could reach $1,200. So long story short, I think that next year is going to be bumpy. I feel like the valuations are a little bit lofty. So I'm expecting roughly a 10% return for 2025. And then going forward to 2030, doing a triple like Tom Lee said, I think that's a little bit too high. I think that these price levels right here is what I expect the market to be at by 2030. It's definitely not a triple. I am expecting some sort of pullback at some point because, like I said earlier, valuations are a little bit lofty right now. It's pricing in perfection. If perfection happens, we'll be okay. So keep your eyes out for that stuff right there. And if you want to learn how I scaled my portfolio so fast, look at my 2-year return. This isn't to brag. This is just to show you guys that could actually be done. I made 242% on a 2-year basis. 1 year 93, year to date 95, 6 months 69. Totally crushing it. Check out my course below. I'll teach you everything you have to know. If you don't want to do my course, click this video right here. It's on a very basic level how to trade stock options. So I'll see you guys there.